In this video, we'll take a look at the accounting implications of inventory management, covering both cost of sales accounting and periodic accounting. We'll also see what happens when you dropship inventory direct from your suppliers to your customers. The value of inventory sold directly affects your profit because it makes up the vast majority of the total cost of sales. First, let's take a look at the inventory that you buy and sell. If you buy the inventory, you own it at some point. If you own something, it's an asset, which must be shown on your balance sheet. If your stock levels increase, your balance sheet assets go up. This is matched by an increase to the debt you have to your supplier, which is a liability, so your balance sheet does not change. You've not made any profit at this point. It works in a very similar way when you pay for goods with cash. Your inventory assets increase, while your cash assets decrease, so no profit again. It's when you ship goods that the profit comes in. If your stock levels decrease, the assets shown on your balance sheet go down. A decrease in inventory value is mirrored by an increase in cost of goods sold, which in turn reduces your profit, and that's why it shows on the income statement or profit and loss. Now, the timing of these changes, when they're recorded, depends on which method of accounting you've chosen. There are two methods of accounting for inventory, called cost of sale and periodic. First, let's look at the cost of sale method. This records increases in assets as soon as inventory is received, and decreases in assets as soon as goods are shipped. You get a cost of sale accounting entry for every single goods out shipment, which lets you see exactly how much profit you're making at any time you choose. At the end of the month, the total cost of goods sold is simply the sum of individual entries. The other method, called periodic accounting, is to figure out the total change to your inventory levels each month rather than doing it for every sale. The month's opening inventory value, plus any purchases you've made, less the month's closing inventory value, will be the total cost of goods sold in that month. The period you choose doesn't have to be a month, but that's the most common approach. Both methods will give you the same end result, but with cost of sale accounting, where an entry is made with every goods in and every goods out, you get an immediate view of your current assets, as well as an immediate view of your cost of sale, and therefore your profitability. It's really important, though, to make sure that the cost values are correct at the goods in stage, since the cost value goes straight through to your cost of sale and affects your profit with no further human interaction. Periodic accounting requires a stock check and then a manual accounting entry at the end of each month, and there's no visibility of assets or profit until this is done, but it does give you more control if you don't want to be looking at your profitability on a very regular basis. Cost of sales accounting is the default method for Brightpearl and is by far and away the most common, so that's the method we'll look at in the rest of this video. Switching between the two methods once you've started trading requires the help of an accountant. With cost of sale accounting, every single change to inventory levels will create an accounting entry, as long as there is a cost price on the goods. When you receive goods, the value comes from the purchase order, in other words what you pay your supplier, excluding any tax, duty or shipping. Brightpearl does not do any automated landed cost calculation. When you ship goods, the cost of sale comes from the value of the inventory you've just shipped. Here's the general ledger in Brightpearl, showing the goods in transaction from a purchase order and the cost of sale transaction for a shipment. On the goods in transaction, you can see we're increasing the inventory because that's a debit, and that's balanced by a liability. You can see more about why it's this code on the Accounting for Purchase Orders video. The goods out transaction decreases the inventory and increases the cost of goods sold. But what if the price of goods is changing? Brightpearl uses first in, first out valuation, which means that if you took 3 separate deliveries of goods at different prices, the cost of the oldest one is used first, regardless of which physical items you ship. Here we can see the inventory detail report for an item that's been increasing in price over the past few deliveries, 10, 11 and 12. We've got a total of 3 in stock, 1 from each delivery. If I ship 2 to a customer today, the 2 oldest items would be used, these top 2 rows, so that's a total cost of goods sold of $21. Receiving and sending goods are not the only processes that make accounting entries. Each time you make a manual stock adjustment, accounting entries are also made. When you decrease inventory levels, you have to do this from the inventory detail report, where you can choose which value you're going to remove. Here let's take one of these items out of stock. Decreasing inventory puts a credit on your inventory code. The other half of the double entry accounting journal is against the corrections code you choose in your setup. This is usually an expenses code, since by decreasing inventory without any sales revenue, you're actually decreasing your profits. The opposite occurs when you increase inventory levels using a stock correction. Your profits will increase. Here's the income statement or profit and loss report. We've made $130 of sales, and we've shipped some goods which are worth $10. We've also made an inventory correction to remove goods of $12. That gives us a cost of sale of $22 and therefore a gross profit of $108. With the cost of sale accounting method, when you create a purchase order and add an inventory item, the account code used is the inventory account code. That's because when you go to receive inventory, we're going to add asset value at the value on the purchase order. The account code for stock items on a purchase order comes from the product record, so you could actually set up different groups of products with different inventory codes to split your assets on your balance sheet. When you receive goods on this purchase order, the value of that account will increase. When you ship that item later, that same asset code is decreased. Non-stock items on purchase orders are assigned a 5000 code or an expenses code, and this value goes straight to the profit and loss report or income statement when you receive the purchase invoice against the purchase order. Now let's see what happens when you dropship goods directly from supplier to customer. You don't ever receive the inventory, so you won't show it as an asset. You don't create a goods out note as you're not shipping from your own warehouse. You do, however, create a dropship purchase order, which is the instruction to your supplier to ship the goods to the customer. Note how dropship purchase orders use expenses codes for inventory items rather than asset codes. That's because you still need to show a cost of sale, but you don't actually see any inventory. At some point in the future, a purchase invoice will be received against this purchase order. That's the point at which the cost of sale is recorded, and it appears immediately on the income statement using the expense code on the purchase order. You might want to set up your dropship suppliers with their own account code specifically for dropship purchase orders so that you can separate your dropship cost of sales from your regular inventory cost of sales on the profit and loss report or income statement. In this video, we discussed cost of sale accounting versus periodic accounting and saw how with cost of sale, an increase in asset occurs with every goods in and a decrease in asset occurs with every goods out. We discussed briefly the concepts of first in and first out inventory valuation. We saw that inventory corrections also make changes to accounts, and then we saw how dropshipping and accounting is different from receiving inventory. And that takes us to the end of the video about accounting for inventory.